Good afternoon, everyone. Welcome back to the Corporate Tax Webinar Series Part 5 by RBS Auditors. With great pleasure, we welcome you once again to yet another informative session. I am Archana, the host for this session, and today we will be discussing about transfer pricing. Before we proceed, let's take a moment to revisit the journey we've had so far. I hope you all watched our previous videos that range from the very basics of corporate tax to areas such as offset of tax losses, relief from double taxation, withholding tax, and foreign tax credit. In case you have missed out on any of it, we have uploaded those videos in our YouTube channel. We encourage you to watch, subscribe, and support us by sharing your valuable comments and thoughts. Also, you can share your feedback as a Google review, for which we will attach a QR code so you can just scan it and leave your reviews there. We invite you to actively participate in the webinar, and in case of any doubts, please comment below so that we can address it in our Q&A session towards the end. In this session, we're going to explore a vast topic in taxes, and that is transfer pricing, including areas such as basics of transfer pricing, arm's length price principles, comparability process, and traditional methods of transfer pricing. We have also included some practical examples to simplify and help you understand this topic better. We are hopeful that your takeaway from this session will be helpful for you in your business and in respect to these areas. Now, I invite the speaker, Mr. Sijin K. Ravi, to walk us through these topics.
Thank you, Archana, for your brief introduction. Ladies and gentlemen, good morning, good afternoon, good evening. Thank you for joining me today for this webinar series, our 5th webinar series on corporate tax. In this webinar series, we are basically discussing on transfer pricing basics and some of the methods used. And transfer pricing itself, it's a vast subject, and we are covering 1 or 2 webinar sessions in order to complete the entire session. So let me share my presentation. So series 5, transfer pricing part 1. So we are basically going into the TP basics. So today's agenda, it's basically transfer pricing basic, then ALP principle, then comparability analysis, that is a CFCEB. We will discuss in details what exactly CFCEB. Then comparability analysis, TP methods, traditional CUP methods, CPM method, RPM method, and some practical examples. So quick overview of this TP. So first one is what are the TP requirements for mainland company, qualifying free zone, international transaction. Then second one, we'll discuss ALP, that 5 TP methods. Then connected person, any payment to connected person is subject to TP. Then remuneration or any payment to directors, partners, or relatives. Then related parties and control, including for kinship by birth, marriage, adoption, or guardianship. Then TP documentation, then BEPS 15 action plan, then OECD TP guidelines. These are the entire view of TP. So if you look at the TP international level, you can see all related party transaction between international. But if you see at UAE context, it will be like a mainland transaction, qualifying free zone, then international. So entirely different between international and UAE TP. So whatever the TP transaction, it has taken from OECD guidelines. And OECD guidelines that they have adopted, plus they have done some adjustment relating to mainland and qualifying free zone, because qualifying free zone having a different tax structure like a 0% and 9%, and mainland it is a straightaway 9%. So these things are very important thing. So let us look at the TP. So there are 4 articles in the transfer pricing. One is Article 34. It's relating to international transaction, then arm's length price. So this is purely on international transaction. In Article 34, again, it is a domestic transaction. Domestic transaction means whatever the transaction between free zone and mainland transaction. Then there is a Article 36, it is relating to connected person, payment to connected person. Whatever the payment to connected person, it will automatically coming under TP. Then the final one, a related party transaction. Then whatever the amount paid to related party or whatever the transaction, it will be included in the TP. Then final stage, Article 55, this is a TP documentation. So only 4 articles are coming. So if you see the 4 articles, first article itself, Article 34 onwards, it was saying that the TP has been adopted by UAE as OECD TP guideline rules. So if you see the OECD TP guideline rules, it is like a 600 pages of OECD TP guideline rules. So if you see in our corporate tax laws, it is only 4 pages, like 4 articles are there, but the guidelines referred for 600 pages. So let us see what is exactly transfer price. So transfer price means one segment of the organization for a product or services. It supplies to another segment of the same organization, like a subsidiary or affiliate or common controlled companies. So whatever the transfer, whatever the amount transferred to the different related parties, then that price is called as a transfer price. So in general term, it is means price between related parties. So in case of a UAE contest, price between related parties and connected person. So let us understand in detail what is exactly TP concept and its sources. So first we will see origin of TP, when it is a TP, how it is arrived, then relevance of a TP for taxation, then importance of OECD TP guidelines and model tax convention, MTC model tax convention. So in order to understand the TP in detail, we have to know that exactly what is the origin of TP. So what exactly origin? In a general terms, that means why we are introducing TP. So for example, for a management accounting, to understand the performance of the relevant segment, see, for example, you have one department, then another department in another location, then you want to understand what exactly the performance of each department, then you have to adopt transfer pricing. Transfer pricing means the price between unrelated parties, whatever the price. So you have to adjust the whatever the transaction, whatever the price charged to related party, and compare with that one to whatever the price to unrelated parties. So for a management accounting in general terms, it is just for a performance, for to evaluate the performance of the relevant segment. If you go to the MNC side, so multinational companies having a different location, having a different companies, in that purpose, they will think about the tax planning. So different jurisdiction having a different tax rate. For example, one country having a 30% tax rate and another company having a 9% tax rate. So automatically they will think about the tax planning. So which country they want to do the transaction between the related parties. So in MNC companies, that will be the concept. If you go to the economic contribution, the members of the group, then they will think about the economic contribution. Both the members of the group, whatever the amount received and the services received, reflect their economic contribution of whatever they have contributed. So it's basically, it's a relating to a related party, which country you have to develop more. So again, it's if it is that country having a lower tax burden, then they will move the business to the different countries. So this is a general terms to understand what exactly TP. Let us say for example, international level. See, holding company Brazil having a holding company, that's a company A, and company B, it is in the USA, then company C, it is in France, and company D in Russian Federation, and company E in Australia. So if company A, it is a tax rate is a 34% corporate tax, and company B, it's a USA 21%, company C, it's a France is a 25%, and company D, it's a Russian Federation is a 20%, and Australia it's a 30%. So there will be a so if the holding company is situated in Brazil, then Brazil tax rate is 34. So if you consolidate the entire financial statement into the holding company level, then there is a temptation that to shift the profit from one location, one country to another country. So you will do the major transaction in the respective country having very less tax rate. So that because of this reason, the transfer price come into picture. So if you let us see the international level, the highest tax rate, Comoros, it's a 50%, and the next third highest is Suriname, it's a 36%, then Puerto Rico, it's a 31.5%. And if you see the lowest one, Barbados, 5.5, and now it's a UAE, it is a 9%, in between the other countries, 7.5 and 8%. This is the entire structure of the international transaction. So why the tax TP is come into the picture? Because of the multinational companies, they are shifting of their the transaction between related party into different location. To avoid this one, tax evasion and tax filing, they are adjusted. So let's see the relevance for the taxation for UATP. See, if you see the previous slide, so we are saying about the international transaction, but relating to UATP, there is a domestic transaction, international transaction, and payment to connected person. So one difference between the international and UATP, it is like international one, it's only related to international transaction between the related parties. But relating to UATP, it is relating to domestic transaction, then international transaction, payment to connected person. Why domestic transaction come into picture? For example, you have a company in mainland and you have a company in a free zone. So free zone, there is a qualifying free zone. Qualifying free zone, there are two tax rates. One is if your company is following its qualifying activities and everything, then tax rate is a 0%. And the mainland tax rate is a 9%. So automatically the tendency to move from one free zone to mainland or mainland to free zone, that tendency will be there. To avoid that condition, the UATP has added another slide. It is relating to domestic transaction. So domestic transaction also come into the picture of TP. And international transaction, this will be applicable for all jurisdiction, that between mainland to the foreign jurisdiction or from a UAE free zone to another foreign country. So automatically the taxation will be there. Then between the connected person, any payment made to the connected person. In a UAE, there is no personal income tax. So because of there is no personal income tax, they have put another condition saying that whatever the payment made to the connected person must be within ambit of TP, transfer pricing. Why it is, for example, you have a company, that company having a manager dimension, you are getting 500,000. You can easily increase 500,000 to 1 million or 2 million, then reduce the profit and again pay the tax very less amount. Because of this reason, they have introduced another clause relating to payment to connected person. That payment to connected person, it is included all categories up to the fourth kinship by birth, marriage, adoption, or guardianship, like a grandparent or grandchild. All this category, it will come into treated as a connected person. If you see OECD guidelines, so you can see connected person, it's clearly mentioned about closely related people, closely related parties. But relating to UATP, because of this reason, they have clearly mentioned connected person means including closely related plus fourth kinship. That means up to the grandparent, great grandparent, great child. All these things will come into the picture. So now recently there is one amendment relating to directors fees. That means from effective from 1st of January 2023, directors fee, whatever the service given to directors fee will be will be removed from the VAT laws. That means there is no need to file. If you are getting any director fee from the another company, then no need to file any return relating to direct fee. But after removing that one, they have included in corporate tax. That means a natural person, any natural person conducting any business or business activity. So director's fees, it is treated as one of the business or business activity. And if that business or business activity in excess of 1 million, in that case, automatically corporate tax will be applicable. That means the director fees is not relating to wages or salaries. That means a person is acting as a director in another company and he is getting fees, directors fee from that company, that will be treated as that person is doing business or business activities. So in that case, whatever the total accumulated director fees, if it is exceeding 1 million UAE dirham, then automatically revenue. That means automatically CT will be applicable. Let's see TP example. For example, PQR Limited, it's a first example, it is relating to unrelated transaction. PQR Limited, it's a selling price to Mark Inc. situated in another country with $120 selling price, and Mark Inc. to the third party customer, it is 140. So let's see the cost part. Cost is 60, sales is $120, and profit is 60. And that country tax rate, for example, 30%, then they have to pay $18. And similar thing, when it's come to the second category, between Mark Inc. and the third party, the cost is 120. because whatever the cost received from PQR Limited is 120 purchase price, and the sales is $140, and the profit is 20, and you have to pay tax at a 10% in that country, then tax is $2. If it is a related party, PKR Limited selling price is $60 to John Inc., another related party in another country, and John Inc. is again to third party customer. So let's see. First part cost is 60, and the sales price I am putting 60. That is a related party transaction by whatever the transfer PQR Limited to John Inc. It's a $60. Then automatically profit in that country it's a 0, even though tax rate is 30%. And come to the second category, it is a cost is a 60, sale is 140, and profit is 8. So in effect, that country you have to pay $8 as a tax, and the other country you have to pay total tax amount is $8. And the first one, unrelated party transaction, total tax rate is $20, and related party transaction, its tax rate is $8. So because of these reasons, the transfer price come into the picture. Let's take another example. A Limited and BINC are the two entities of a mini group. A Limited took a loan from BINC at an interest rate of 20% per annum, whereas the market interest rate is a 10% comparable uncontrolled entity. That means the market rate is only 10%. So A Limited, it's taken from B Limited. Let's say A Limited tax rate in that country is a 30%, and B Limited tax rate in that country is a 20%. So automatically, B Limited will get interest from A Limited, and they have to pay tax on 20%. And what is identity for A Limited? A Limited, whatever the interest paid, they will get a deduction. Then what is the net effect means higher tax jurisdiction, it's a Limited, so automatically lower tax jurisdiction, it's a B Limited. The net effect is a 10% excess interest paid. So you will get a 10% excess interest paid. That will be the tax savings. So because of this scenario, transfer price come into the picture. Hope that you are understood the entire transfer price, why it is introduced, what is the reason, and just to give you a brief example to this scenario. Let's see a historical background of TP. It's a way back in 1915, UK adopted the transfer pricing legislation. And after that, in 1970, USA adopted. And in 1948, OECC, Organization for European Economic Cooperation, was established. And 1961, OECD, that name has been changed, and it has added Organization for Economic Cooperation and Development. Then 1979 to 84, then a report on transfer pricing issued by OECD, 1979 to 1984. Then 1984, UK CFC rules adopted. CFC means a controlled foreign corporation. What it is, it's basically a related party, controlled foreign corporation or controlled foreign entity. So that rules it is adopted by UK. Then UN is issued a report on international income, taxation, and developing countries in 1988. OECD 1995 TP guidelines issued by OECD. So first one is a TP report is issued, then TP guidelines issued in 1995. Then 1999 UN TP issued by UN Conference on Trade and Development in 1999. Then guidelines on low value adding intra-group services issued by European Union in 2011. And 2016, communication on fair, efficient corporate tax system in EU by Economic European Union. So let's see what about the TP relating to UAE. 2017, European Council announced a list of non-cooperative jurisdictions for tax purpose. UAE was one of the tax jurisdiction along with 17 other jurisdictions. In 2018, European Union later list was revised and UAE was removed from the blacklist and moved to the gray list in 2018. May 2018, OECD, UAE joined OECD Inclusive Framework on BEPS Action Plan and decided to implement 4 minimum BEPS Action Plan. See, whoever may be the member country joined in OECD, they have to at least minimum, they have to maintain 4 minimum standards. So UAE has adopted that one. And April 2019, ESR will be, ESR, it's adopted on 30th April. US Ministry of Finance has introduced ESR on 30th April 2019. Cabinet Resolution number 31 and amended decision number 57 and country by country report issued by UAE. Then 2022, April 2022, MOF, Ministry of Finance, issued public consultation document for the corporate tax. Then 2022 and 2023, 9th December 2022, released a federal decree law number 47, 2022 on taxation with effect from 1/6/2023. So this is a brief idea. So our previous slide, we have mentioned the 4 minimum standard. BEPS session, we have already discussed in the first webinar series. These are the BEPS session point, 15 action point. In that 15 action point, 4 minimum standard. One is a harmful tax practices, then preventing tax treaty, then transfer pricing documentation, then a dispute resolution. This is all member company, they have to maintain this minimum 4 standards. So UAE has already adopted these things, and the rest of the things on. So if you see introduction of UAE transfer pricing, so based on the BEPS action plan, they have straight away adopted a 4 action plan. Based on that 4 action plan, Article 34, arm's length price, Article 35, related parties and control, Article 36, connected person, Article 55, transfer pricing documentation. So again, if you see, UAE introduced comprehensive TP regime, which is broadly aligned with OECD TP guidelines. So straight away, it's a UAE has adopted OECD TP guideline. So what is the relevance for TP for taxation? So basically, there is the OECD, then WTO, then UN. All these transaction, all this economic transaction, based on that country has been adopted. So OECD TP guidelines, it's UAE has adopted, then UN guidelines, then US guidelines. All this will be separate TP guidelines, and based on that one, it has adopted. For example, domestic transfer pricing, you can adopt a domestic transfer pricing if you have proper documents. See, for example, in case of an India, domestic transfer pricing, there is a connected person, there is clearly mentioned about income tax that 25%, 26% or more, it is treated as related party. But in case of OECD guidelines, a related party, it is mentioned like that 50% or more. So depending upon domestic transfer pricing, you can adopt that domestic transfer pricing plus with the OECD guideline. So let's see the relevance for TP for transaction. For example, a company A situated in one country, company B situated in another company, company C situated in another company, and you have to consolidate entire group profit. So if you consolidate the entire group profit, the TP does not ordinarily change the combined profit of entity. This will not change the combined profit of entity, but it is split between the entity, split between, for example, whatever the split between company B, whatever the profit relating to company B, that will affect. That means that respective country has to do the adjustment in their respective jurisdiction. Then you do the consolidation. So company B having an issue, so company B having a transfer pricing issue, then you have to adjust the transfer pricing details in company B. That means the respective jurisdiction you have to adjust. Then it will automatically combine with the consolidated financial statement. So in order to fair allocation of taxable profit, then you have to adjust in the respective domestic tax law. So fundamentals, OECD guidelines, then OECD transfer pricing. This is just like a guidelines, not legally binding on states. Then some countries have incorporated guidelines to their own domestic legislation. Then Article 9, associated enterprises, Article OECD Model Tax Convention, it specifically says about Article 9, it's relating to associated enterprises. Then allow adjustment for inappropriate TP. So whenever there is an TP adjustment is required, then this will be adjusted. So this is the fundamentals about the OECD. So we have adopted OECD guideline principle. So you can adopt, some countries have incorporated guidelines to their own domestic legislation. For example, I discussed previously, OECD guidelines, Article 9 relating to associated enterprises. Associated enterprises, as per closely related enterprise, it's defined, it's relating to closely related enterprises. So closely related enterprise, it is 50% or more, that 50% or more in the shareholding, 50% or more in the board of directors, or 50 more than board of directors, then control in the condition 50% or more. So in that case, it will be treated as a related party or associated enterprise. But if you are adopting their own domestic legislation, that's why some countries are domestic legislation. In that countries, if it is a 26% or more, then that will be treated as the respective related party transaction. So depending on, either you can adopt domestic legislation or adopt international one, OECD. So for relating to UAE has adopted OECD guidelines. So let us look at arm's length price. So we'll discuss the meaning, OECD TP guidelines and everything. So arm's length price is the price that is paid in a comparable transaction between unrelated parties. So you have a company and you are doing a transaction between the related party and between unrelated party. So you will consider whatever the price paid for the unrelated party, that will be taken into consideration in order to arrive the price of the related party transaction. So basically TP will be applicable only for a related party transaction, not for unrelated party, only for related party transaction. So in order to arrive the correct price of the related party transaction, you have to compare with unrelated parties. So that's why arm's length principle. That means within arm's length, whatever the price you are deciding, that will be your related party. You have to adjust with the related party prices. So there is a arm's length test process for comparing actual transfer price with the arm's length. So treat the arm's length approach. First, it treat entities involved as if they were unrelated, and then remove artificial transfer pricing, whatever the price you have top up into that arm's length price, that will be removed. Then you have to find out how much is the actual price. If that same item, if you are selling to the unrelated party, what will be the price? So that you have to arrive the actual. So Article 34, it's a UACT. It's clearly mentioned about there are 5 different methods to understand how to arrive the transfer pricing methods, how to arrive the transfer price, arm's length price, along with different factors. There are 5 factors. One is the contractual terms, characteristics of the transaction, economic circumstances, then function for analysis, then business strategies. So we'll discuss that one, comparability factors and comparability analysis. So first, there are 2 steps are there in order to arrive at arm's length price. One is a comparability factors. Second one is a comparability analysis. So what are the 5 factors? One is the contractual terms. So the relationship between comparability factors and analysis is very important to understand transfer price. Both are not same. So one is relating to factors, and the second one is after arriving the factors. Second one is relating to analysis. So comparability factors. First one, these 5 comparability factors you have to analyze. After analyzing these 5 comparability factors, then you have to arrive at the pricing analysis. So there is a test after this one. So that basis we have to arrive the ALP price. So there are 2 processes. One is 5 comparability factors, and the second one is comparability analysis. We will see this process in detail. One is 5 comparability factors. One is contractual terms. So for example, if you are taking a related party transaction, contracts may be explicit contract or implicit contract. That means some related party transaction, they don't have any contractual agreement. So for example, relating to managerial remuneration. So if you are thinking about managerial remuneration, mainland company, they don't have any contracts for managerial remuneration. It will be decided by the management itself without having any contract. But if you go to the free zone entities, so they'll be having a contract for the remuneration itself. If you are one of the manager of that company, then automatically the contract will be there. So there is an explicit contract or implicit contract. Other cases, like for example, if you are doing a related party transaction, there is no formal contract will be there. There is no, if it is a third party transaction, there will be lot of condition, like a payment terms will be there. Then within 60 days they have to pay, or cash basis, then FOB basis or CAF basis. But relating to related party transaction, you can find some transaction having a contract, some transaction not having a contract. So it's a difficulty factor is you have to decide what type of a contract it is going on, and how the contract is created, whether terms of contract is within as per the unrelated party, whether they have created on that basis. So first contract, it's a contractual terms. You have to analyze how the contract. So first you analyze the related party. You just see the related party, whether related party having a transaction, okay, whether that related party having a contractual terms, whether what is the terms of the payment or terms of the conditions, then a risk, then a reward, all these things you have to clearly analyze. So first you have to analyze the transaction, what type of transaction, whether contractual terms are in agreement. If you are doing with an unrelated party, whether they are following. See, for example, relating to third party transaction, they will maximum, they will increase their benefits relating to, they will increase their benefit to try to reduce their risk. That means the price will be in a competitive way. But in case of a related party transaction, the price will be decided between the management. Then it is not up to arm's length price. Then second category, functional analysis. This is an important area. Most significant focus is undertaking on comparability analysis, functional analysis. What are the function performed? What are the asset employed? What are the risk assumed? See, for example, you have a related party, the centralized purchase. In that case, you must be taking different warehouse in a different location in order to support the different countries' requirement. So if it is a MNC company, if the centralized purchasing is utilized, then you have a different location. Then from that country, they will be delivering the goods to the respective location. So you have to decide what are the asset employed, then what are the risk involved in that case. See, for example, one location having issues, then you can get it done. You can get the goods from the another location. So functional analysis, you have to decide what are the function for the each entity wise. You have to decide, then you have to find out, then you have to do the adjustment. So first one is relating to contractual terms. Once contractual terms is analyzed, then the next one is relating to functional analysis. Then third one is relating to characteristics of property or services. See, for example, different characteristics will be there, difference in their specific value. For example, if you take an tangible property, that availability, quality, volume of supply features. If in case of an intangible property, its form, what type of IP used, then duration, then degree, all these things you have to compare. So you will be using a different method, like a cup method, or RPM method, or resale price method, or cost plus method. So different method will be used based on the product characteristics or services, whether you are doing for a IT related services or you are doing for a other related services, other tangible related services. If you are selling a goods, then it will be a tangible. If you are selling as an intangible, then that category, or service category, product or services. For example, even for a MNC company, the centralized human resources supported by MNC company, then in that case, sharing of that one. Or in case of management fee, so the entire accounting system is operated from the centralized way, then in that case, management fee allocation, that will be involved. So in this category, you have to analyze. So third one, it is relating to property or services. And fourth one, relating to economic circumstances. Some cases, certain factors beyond the control of the parties. For example, purchasing power of in a country, purchasing power it's very low, then you cannot say that the purchasing, you cannot increase that purchasing power. For example, in a low income country, the high value of a television set, it is very difficult to sell. So that purchasing power you have to see. That means economic circumstances of the each country wise, you have to analyze what is the state of economic circumstances, then degree of competition, how many competitors are there, how their product pricing. So all these things you have to analyze and you have to record. And after this one, fifth one, it's business strategies. For example, market penetration. You are moving one, you are shifting to a new market. For example, in a Japanese group, the product they want to introduce in a UK market. UK market, there is no Japanese product. Television set, let's say television set, they are not having any Japanese product in a UK market. In that case, in the initial year, high setup cost will be there. So the mostly the marketing cost, then promotion cost, all this will be very high in that location. Then the first year of operation, it will be very less profit or loss will be there. Then the in order to earn with a low profit, that is possible, but in case frequently you are getting a loss. For example, independent enterprise, company A is located in one country and company B is located in another country, and company B is making losses frequently in a first year because of that market penetration, or you are introducing into a new market, then the cost will be very high, the automatically profit will be very less. But if you are moving, if you are the loss, every year it is loss, then automatically OECD guidelines is specifically says that then that entity must be scrutinized with wherever the associated enterprise is based. So you cannot, in a long term, you cannot keep it like that, that entity alone loss for a long term. So that first year it is fine, like that because of business strategy, it's a low profit or loss making company, that is fine, but it's you cannot put on a long term basis that entity it's a loss making, that is not possible. So these 5 factors, it's a first stage, that is comparability factors. Whether we have to, why we have to do all these 5 factors, because there is a local file, master file, and TP document declaration file. In this local file, you have to mention about all these 5 factors. You have to note it down whether you have considered all these 5 factors. On based on that one, you have to come to the ALP price. So this is one of the part you have to record in your TP documentation. Now, after applying CFCEB relating to the 5 factors, the next step is to comparability analysis. So comparability analysis, first you are analyze the terms factors. Then after that one, you have to analyze and compare with the analysis. Of larger sample comparable, then likelihood of ALP will be very good. So this step is like a 5 comparable, then comparability analysis, then selection of the best method, then comparability adjustment if you are to do some adjustment relating to that price, then final stage will be ALP price. So these are the steps involved. So we are already discussed 5 comparability analysis, then we are going to discuss about the comparability analysis. Factors we are discussed, second one is a comparability analysis. So first step, determination of years. So which year you are going to, so 5 factors you are compared. Next one, which year you are going to compare the transaction. For example, you are taking for 2023 transaction, then that year. So years to be desired. Step 2, it's based on the broad-based analysis of taxpayers' circumstances. That means the industry, competition, regulatory factors. For example, I explained about the Japanese market. So you have to see that industry, whatever the competition, whether it is a new product, then what will be a regulatory requirement relating to that country, then you have to analyze. And moving on that one, step 3, controlled transaction. You have to find out who is a tested party and whatever the control transaction. Control transaction means a related party transaction. You have to review the related party transaction. Then you have to choose the party. We will discuss in detail about what exactly the tested party. Then after reviewing the transaction, so you come across you are decided the years, which years. Second one, you come to know that what broad-based analysis of taxpayers circumstances, which country it is located and their condition, regulatory factors. Then third one, it is you are analyze about the controlled transaction, and you have to select a tested party. Controlled transaction means related party transaction. Then after a related party transaction has been selected, then existing internal comparable, whether internally you can compare that price. If possible, you do the internal comparable. If it is not possible for internal comparable, then you do the external comparable. You have to do external comparable. Tested party is a simple thing. It's a simple party without having any reliable party, most reliable party of the transaction. And after step number 4, relating 4, it is internal comparable. Fifth one is external comparable. Then you have to select most appropriate method for transfer pricing. So whether which method you have to apply for a transfer pricing methods. Then identify potential comparable. What are the potential comparable? You identify one transaction, you are comparing with another transaction. That potential comparable you have to identify. Then you have to do some adjustment. For example, you find out one transaction, then that transaction, it is on a CAF basis, carriage, price, insurance, and another transaction on FOB basis. Then you have to do some adjustment to make the price into FOB basis. What will be the price? Then step number 9, then arm's length range you will get, then interpreting that range, then finally arm's length price. So these are the transaction up to nine step you have to do. This is as per OECD guidelines. In that OECD guidelines, step number 5 to 7, you have to do repeatedly. You have to do one by one. You have to analyze which method. First, for example, you analyze the RPM method. So if it is not working out RPM method, you have to find out the second method. So like that, 2-3 times you have to do step number 5 to 7. Then you have to arrive at the ALP price. Then that ALP price will be adopted for the transaction. So tested party is the one which transfer pricing method can be applied in most reliable manner. For example, let's say company A manufactures 2 type of products. One is a P1 and second one is a P2. And it sells to company B, an associated enterprise in another country. Assume A is manufacture product P1 by using valuable, unique, intangible that belong to B. So that means it's a P1, the product is manufactured by company A based on the relevant technical specification provided by the company B. That means all technical things it's provided by, that means a unique, intangible, then product valuable, what are the combination, everything is provided by B. So in that case, A is only doing a simple function, just manufacturing, and it does not make any valuable, unique contribution to the transaction. That means in that scenario, tested party is P1 for the tested party will be A. Company A will be the tested party. Let's see another example. Assume A is also a manufacturer of P2, product P2 is also a manufacturer, for which its on use of valuable, unique, intangibles such as valuable patent, trademark, and everything, it's owned by company A. And company B act as a distributor. So company B, it's not having any control on whatever the product relating to product P2. It's entirely manufactured by company A, but it's a distribution, it's a company B. In that case, tested party for P2, product P2 will be most probably B, because it's a simple transaction. So tested party means most reliable transaction, you can do an adjustment. So that is what a tested party it says. Now we will see the step number 4. Step number 4 and 5, it says about internal comparable and external comparable. Internal comparable means between one party to the controlled transaction and other party to the uncontrolled transaction. So internally, you are doing that internal comparable. So within the company itself, you have for example, 40% it is relating to controlled transaction and 60% is relating to uncontrolled transaction. So you can compare that internal comparable. If it is an external comparable, means you don't have any comparison between whatever the related party transaction. You cannot compare with another uncontrolled transaction. In that case, you have to go with external comparable. External comparable means a database. You have to see the database from the portal. Different portal will be there. Then foreign source, non-domestic comparable information. Then third-party data. So you have to find out the external party. From external party, you have to find out the price. Then you have to adopt those price if you do not have any internal comparable. So best method, if you have an internal comparable, then straight away you can take to internal comparable. No need to check for external comparable. In that step number 8, it says about the comparability adjustment. That means if accounting adjustment you want to do, one transaction it is relating to one method of accounting, then another transaction is another method of accounting relating to uncontrolled transaction, then you have to do the adjustment. Then function risk analysis, then non-comparable, you have to non-comparable transaction you have to see, then materiality you have to see, then minor adjustment. So if there is not material figure, then no need to do any adjustment relating to that one. So you have to see that materiality level, accounting impact, then another for analysis, function analysis, then only you can do the comparability adjustment. After doing comparability adjustment, you will get arm's length range. Then if it is arm's length range is outside ALR, then again tax authority, they can challenge for that one. Then they will find out what will be the arm's length price. Then if it is within that range, then ALP falls within that range, then no need to do any adjustment. Then other tools are there. Then you have to take a median. Median means it's the price is between one point to another point. Then you will be taking the median figure. Median price will be the arm's length price. Then after that one, most appropriate methods, we have discussed step number 6. You have to see the availability, coverage, and function analysis, nature and class of transaction, all these things. Based on that one, you have to select most appropriate method. And step 6, then we will see transfer pricing methods. So the previous steps are relating to 9 steps. We have just discussed about some of the steps in detail. After that one, transfer pricing methods will be followed. So let's see what are the transfer pricing methods. Article 34, it's a UAE tax laws. It says about 5 transfer pricing methods you have to follow: comparable uncontrolled price method, CUP method, resale price method, cost plus method, transaction net margin method, transaction profit split method. These are the 5 methods you have to follow. These are the 5 methods prescribed by the OECD guidelines. And you can adopt another method, but your taxable person has to demonstrate that none of the above method is reasonably applied. Then taxable person has to demonstrate that this method I can adopt, but they have to give a proper documentation relating to that transfer price method using other than these 5 methods. So let's see traditional transaction method and transactional profit method. So traditional method is a comparable uncontrollable price method. That means a CUP method, resale price method, cost plus method, then transactional profit method, profit split method, transaction net margin methods. So comparable uncontrolled price method. So this will usually applicable for interest rate, royalty, license fee, purchase and sale of goods, provision of services. Then resale price method, it will be adopted for trading operation, buy and sale without any value addition. Then cost plus method, sale of semi-finished goods. Then profit split method, intangible, basically intangible, it will be arrived based on the profit split method. Transaction net margin method, manufacturing operation, trading operation, RPM is inadequate, provision of services, all these things. Transaction net margin method is used. Any other method, then the taxpayer has to and taxpayer has to demonstrate how that method is used. So first is a CUP method, comparable uncontrolled price method. So comparable uncontrolled price method, sale, purchase and transfer of goods or property, head office or management fee, you are allocating management fee to different entities, then that will be, you can use for CUP method. Licensing of intellectual property, then licensing of property and equipment, loan or guarantee, you are giving a loan to another related party, then CUP method you can use. Reallocating a cost or recharge of staff cost. So if it is a centralized HR, then in that one, human resources, in that one, you reallocating the respective staff cost, you can use the CUP method. So first you have to, first condition, main thing, CUP comparison between controlled and uncontrolled transaction. None of the differences is that. That means a very minimal level of difference, then only you can adopt a CUP comparison method. That materiality affects the price in the open market. None of the differences. Then second one, and after if any minor differences are there, then you should able to reasonably adjust that price. Then only you can do CUP comparison. So for example, in a CUP comparison method, CUP method compares the price charged for property or services in a controlled transaction with uncontrolled transaction. So they will compare with related party transaction with unrelated party transaction. For example, selling price is 100 for the controlled transaction. Controlled transaction means related party transaction. That will be compared with the uncontrolled transaction. The same item, it's an uncontrolled transaction, it's $150, then that will be comparable. Then you will be doing the adjustment. So the high degree of comparability, CUP method requires high degree of comparability. If it is a compare very without having major adjustment, then only CUP method will be followed. And if you see the OECD guidelines, chapter 2 and 2.14, it specifically says that if there are two prices, like a selling price is $100 and another selling price is $150, and associated enterprise are not arm's length, that price of uncontrolled transaction may need to substituted, that a transaction price, whatever the price of uncontrolled transaction, you have to substitute for the controlled transaction. So controlled transaction, it's 100. So automatically it will be, controlled transaction will be priced at 150 and arrive at how much is the profitability of that business. So there is an internal CUP. Internal CUP means internally you can analyze the transaction, unrelated party. You have two parties. One is relating to a related party transaction, and the second one is relating to unrelated party within the organization itself. For example, company A is selling, company B is situated in another company. You are doing a sale to that company, a related party, that company, and you are doing the same item to unrelated party in another country, then you can compare that pricing, because you have a transaction within the group itself. That's why the internal CUP means a transaction between a tested party and unrelated party. A tested party we have already discussed, that is a simple party without having much complication. And external CUP, external CUP means you don't have any internal CUP. That means you don't have any internal CUP to analyze the transaction between controlled and uncontrolled transaction. Controlled means a related party transaction and unrelated party transaction. In that case, you can go with the external CUP. That means unrelated parties. Then a transaction between two unconnected parties, then you can do the adjustment relating to that part. For example, you are just to understand the concept in detail. For example, you are selecting a red apple and a green apple. In CUP method, you cannot compare red apple price with the green apple. So if you are following in the CUP method, you have to just see a red apple, then the specification. Even a red apple having a different varieties, then a Fuji red apple is there, then Honey Crisp, then Jonathan, different names are there. So you cannot compare straight away the Royal Gala Red Apple 8.15 per kg or AED You cannot compare with that one with Fiji. So if you are comparing this with Royal Gala, then it is fine. So if you're comparing with something else, then it is not possible. Similarly, green apple, you have to compare with the green, but again, there is a ginger gold is there, green. Then golden delicious is there. You cannot compare with the golden delicious and green apple, then because the pricing will be different for each one. So cup method means a cup method need a high degree of reliability is required for a cup method. So if it is a purely, you can do the comparable very well, then you can take the cup method. So it is very difficult to find out that type of comparable. For example, you can see a taxpayer MNE sells 60% of its product to associated company in B at a price of $100 per unit. At the same time, the remaining 40% of product is sold to an independent enterprise C at $150 per unit. So one is to related party, it is $100. To unrelated party, it is $150. If you see the percentage, 60% it's a related party, 40% it is unrelated party. So this is basically what type of cup? Internal cup, because within the organization itself, you have a controlled transaction. Controlled transaction, it's relating to a related party, and you have a uncontrolled transaction relating to unrelated party. So if you take this scenario, all other features or all other functional analysis B and C must be first carried out. First, you have to carry out functional analysis of the 5 factors you have to carry it out. If there is no major differences, no other adjustment is required, then in that case, uncontrolled transaction, that will be the price of $150 per dollar. That will be the price of the transaction between B and A. That means a related party transaction will be priced at 150 and it will be arrived at the whatever the profit involved in that. So another example, a manufacturer A export its product to associated company at $100. Manufacturer export the same product in a similar quantities under similar terms of company to company Z, an independent party operating in a similar market as a B at a price of 150. So uncontrolled transaction, it is a 150, and uncontrolled sale price, it's on based on delivered price. Uncontrolled sale price, that means unrelated party, it is a delivered sale price, and controller related party is FOB factory, that means a free on board factory. So in that case, for example, let's say transportation and other duties, it's $10 and $5, then what will be the ALP? So we have to do adjustment relating to this one, because if you see uncontrolled transaction, it's a sale price is a delivered price, and controlled transaction, related party transaction, is on FOB basis. So what we have to do, made FOB factory selling price to H to Z, it's 150. You have to take you should not take a related party transaction pricing. You have to take unrelated party transaction first, then you do an adjustment to arrive at the figures of the ALP price. So in that unrelated transaction, it is $150, and a related transaction, it is $100. So you have to take an unrelated price, $150. Then you do the adjustment for freight duties, that are $10 and $5, then automatically 135 will be the ALP price. So after eliminating the adjustment, you will get ALP price. So this ALP price will be applied for controlled transaction, and tax will be paid on that price. So if you see the cup method summary, there is an internal cup, external cup. Then if internal cup is available, then straight away you go with internal cup. That is the best method. Then there is a tested party. Then you have to see 5 points, contractual terms and everything. Then if contractual term can make difference in contractual terms, if a difference in contractual terms, then cup is very difficult to analyze the things. And adjustment cannot be made for material product differences, trademark, and all these things. Adjustment cannot be made. So in that case, the cup method, it is not possible. Then next method, RPM method. RPM means a resale price method. So resale price method, the price price at which a product has been purchased, whatever the price that a product has been purchased with the associated enterprise is resold to an independent enterprises. So in simple terms means whatever the price you are getting in that one resale price, simple terms, whatever the resale price, that means the sales, then cost of sale, then you will get the gross margin. So we will be focusing on that GP margin. Based on that one resale price will be decided. We'll discuss in detail to understand the concept in by example. Let's say US company distribute a running shoes purchased from a related company in Ireland. So they are purchased from a related party from Ireland and also purchased very similar but not identical running shoes from unrelated supplier. For the purpose of this, let us assume that all terms and conditions of related party and unrelated party are comparable. Sale is 500,000, cost of sale is 350,000, gross profit is 150,000, and GP ratio is 30%. So you are arriving at GP ratio of 30%. If the shoe sold from Ireland to US is $200, the appropriate profit can be determined. It's 200 into 30%, $60. It's appropriate this one. And if it is $100, sometimes the distributed $100 for that shoes, and still if they are GP ratio is 30%. GP ratio is arrived, it's already arrived that the sales, cost of sales, GP 150 for that product is a GP ratio straight away 30%. So gross margin 30% should be acceptable by tax authority because a resale price method you are adopting. So this method, you will be arriving at the normal profitability GP ratio, then you are applying that GP ratio with the selling price, then you are arriving at the pricing. So in that case, if you see the same example, corporate tax 12.5%, 12.5% corporate tax rate in the US and 21%, 12.5% in Ireland and 21% in US, then the company can shift the profit, artificially shift the pricing based on that tax rate, because US tax rate is 21%, Ireland tax rate is 12%, then they can do the higher tax jurisdiction. They can shift the purchasing, which area you have to purchase, which area you have to do the sales. So that's why the transfer price come into the picture. Then so you will find out what is the resale price, then you will you will arrive at the price. The next method is a CPM method, that means the cost plus method. So in this method, you will be arriving a cost, then in that cost, you will be adding the markup to that one. That cost means sales, then a cost of sales, then GP will be there, then a related cost will be added, then the final figure, that figure will be added back to the profit percentage, then you will get what will be the cost plus method. So for example, a related cost relating to purchase cost will be added, then relating to the transportation cost, freight cost, then any other cost involved up to the destination, what are the cost involved, that you will get the total cost. Then that total cost, you will be adding a percentage of margin. For example, GP margin is 30%, then that GP margin is added to that cost, then you will be automatically calculating the price. So CPM is typically used in contract manufacturing, toll manufacturing, intra-group provision of service. The toll manufacturing means companies are responsible for producing their raw material or finished goods. In that case, toll manufacturing. Then contract manufacturing, you will be doing distributing the goods. Only distribution is required. In that case, cost plus method is used. Let's see one example. Company T assembles computers and sell them to a related company S, who will distribute them. It establishes a gross markup 30%. So GP markup is a 30% for the product. All product is GP markup is a 30%. The cost incurred for that one up to the stage of product is 300,000. In that case, a TP will be 390. That means cost plus markup. So sales for in this case is 390. because the cost of sales, then you are adding a markup of 30% into that cost of sale, 300,000 into markup 30% and 90,000, then that will be the transaction price. That will be the TP price. Another example, X LLC is a transferred goods to wholly owned subsidiary Y LLC for a 150,000. X LLC has incurred the following cost of production for such good. Cost of raw materials 75,000, labor cost is 25,000, apportioned indirect cost is 20,000. So total all cost together 120,000, then 120,000, it's a 25% markup is for the normal product, then 25% markup added, then TP price will be 150,000. So cost plus method, it is you have to just initially you have to arrive at whatever be the cost involved for that product will be markup with the percentage of GP. Then you will get transfer price into that one. So we have discussed mainly for TP traditional transfer pricing method. These are the three methods. This is basically transfer pricing. It's a big topic. It's OECD guidelines. It is like 600 pages of OECD guidelines. So this is the OECD guidelines. They are given, and UAE corporate tax, they have adopted OECD guidelines for the entire thing. So even though the 4 articles are mentioned, the entire transaction, it is based on OECD guidelines. So you have to refer OECD guidelines to arrive at the figures. So next webinar, we will be doing the other transfer pricing methods to understand the concept in details. We have already discussed traditional TP method, then the transactional method. Other 2 methods we'll discuss. This is a vast topic, so you have to go 2-3 times to understand the concept in details. So if you you can go to our LinkedIn or YouTube or Facebook, or you can email us, and you can put your reviews and everything in our Google review. Then we have already uploaded first webinar, second webinar, and third webinar, and fourth webinar relating to the respective CT. You can go through those areas in order to understand whatever the related TP areas. For example, connected person, it is we have already discussed who is a connected person, then a related party transaction and everything. So in that we have clearly mentioned that a different TP method you have to adopt. So TP method we have already discussed in detail.